Martin Friedrich I know since almost 20 years. He has been with Haku Trust for 10 years as co-CIO. And then he joined Lansdowne in 2019. And I think he has a lot to say about asset allocation. Thanks a lot, Martin.
Thank you.
Floor is yours.
Thank you, Alex. Can you hear me? Is the microphone on? Yes. So thanks everybody for coming and your interest, and thanks Alex for the invitation. I'm facing several challenges here. First of all, as I'm addressing a room full of people who are really interested in investing in equities, and I'm talking about a multi-asset fund and commodity futures investment. The second challenge is that we just heard that it's all about narratives, and I'm now going to talk to you about data and statistics and a little bit about forecasting. And so I hope it will add a totally different angle to the discussion today. First of all, I just want to say a few brief words of introduction and what I'm actually doing, just so you understand the context from which I am looking at the world. And the company I work for is Lansdowne Partners. Lansdowne was founded 25 years ago in London by two gentlemen, Paul Ruddock and Stephen Hines. It was mostly known as a alternative asset manager, a hedge fund. And then over the years, a few things developed. Firstly, Lansdowne has developed away from the long-short investing routes, and today it's mostly about long-only strategies. Secondly, the two founders increasingly pulled back from the day-to-day operations. They're still involved, but Paul Ruddock has looked a lot after philanthropy lately, and he's now called Sir Paul Ruddock, partially as a result of that. And Stephen Hines has left the UK and moved to Vienna with his family in 2010 and bought back the house of his grandfather there. And that's how he founded Lansdowne Partners Austria, and he now uses that platform to enable additional strategies, and that's how young talents like myself get to start their own funds at the age of 55. The fund itself, as I said, we call it the endowment fund because it has a number of features that mirror the investing style of those institutions. It's very different in only one aspect, which is that it's liquid. So it's a UCITS fund, it's daily tradable, and that obviously means a few differences. I'm going to briefly touch on the investment philosophy. I can't go through the entire investment process, but it's interesting to note that obviously these endowments have had enormous returns over the years. I've just, been a fan of that ever since I joined HQ Trust in 2009, and I've started collecting that data. And so I can show you here 5 curves. The top one is kind of the model endowment, University of Yale. That's where Svensson worked. But then I also show the average of the top 6 endowments. So there we throw in Harvard and Stanford and MIT and 2 others. And we have then the average of all large endowments, the average of all endowments. And then the very bottom curve here, that's what you get from a private bank. That's essentially 50-50 bonds and equities, less 1% per annum for essentially costs and fees. And I think that's a fair comparison because the endowments also report their returns on a net basis. What the left side of the chart doesn't tell you is obviously the risk that was employed in order to generate these returns, and that's why we built the right side. And here you can see, yes, endowments, the larger they are, the more risk they take, but they take the risk in a way that it's used efficiently. So you cannot explain the additional returns only by the additional risk, because if you could, then all these diamonds would have to be on this risk equivalence line that I put in here, and they're not, they're higher up. So we just say what is behind that success, and we were able to define a number of attributes to the investing style of endowments. And we find that we can actually build a lot of those into our investment process. What we can't do, obviously, is the high investment into illiquids. We can't have private equity or private debt or real estate in the fund. But we can do a number of the other things. Just to quickly explain why are these investors so different. Obviously, they have a very long time horizon. Investing horizon is essentially forever. They have always used very broad diversification. The reason why they are different, however, also lies in the fact that they're very rational. All these Ivy League universities, they have capital market research departments. They have professors there, and these professors then interact with the decision makers in the investment offices, and it's very hard for them not to, use portfolio theory and capital markets theory. And it just means if you're very data-driven and very rational, it automatically leads you to unconventional asset allocation patterns. And so it shouldn't really be a surprise that endowments were the first ones to invest into equities in a big way in the 1940s and 50s, at a time when endowment investing generally was only fixed income based. And then 1980 onwards into hedge funds, 1990s private equity, and so on. You know the story. The rest of the points is also quite interesting. Obviously, anti-cyclical investing patterns, which we show on the bottom right here as a big study here. I reference this in the footnote. They're all active. There is no passive investing there. Even though they could go passive, right? They don't need to respond to anyone. They're just responsible for the wealth of the future generations. And it shows to go active, and they've earned excess returns even in liquid asset classes. So active management works if it's done correctly. And then last but not least, they don't make the selection decision themselves. They use external asset managers. So we mirror that obviously by being a fund of funds, and that's done for a very good reason. Now, how do we put all of that into an investment process? Again, if you're interested, give me your cards afterwards, and I'll be happy to supply you with more information. But essentially, we do 3 or 4 distinct process steps. We do strategic asset allocation, we do tactical asset allocation, and we do implementation. And as you can see, over the last 3 years, this has worked very well. We had a bit of a setback during Corona, but essentially this result means that over rolling 3 years, we're in the top 3% of multi-asset funds in our peer group. And over the whole period, we're in the top 10%, and we have 5 stars everywhere you look. Now, why does it matter to you, and why does it matter for commodities? Obviously, because commodities is one of 17 asset classes that we invest in. And I now want to switch tack and just, maybe show you a part of the fund. It's only, below 5% at the moment, but it can go up and down, obviously, over time. I wanted to provide a few of the ways that we try to forecast the return of commodities, because yes, forecasting is difficult, but we have to forecast the returns of our 17 asset classes in order to do what we do, which is what I just showed you. Otherwise, you can't actually come up with a good strategic asset allocation. And if you look at commodities in a multi-asset context, then I think the most important chart is here. The different asset classes have different sensitivities to macroeconomic factors. And the most important factors are growth and inflation. And what the interesting thing is that commodities, they like growth and they like inflation. Bonds don't like both. And equities, they don't like inflation, as we found out last year, I think. And they do like growth. So there is more commonality between commodities and equities than commodities and bonds. which means commodities are a wonderful diversifier for your bond portfolio. They're still diversifying, but they're a less great diversifier for an equity portfolio because they have this shared tendency to react positively if growth goes up and vice versa. Now, in terms of the return potential of commodities, there is this constant misunderstanding that I found, and it's actually not so bad here in Switzerland, but in Germany there is a lot of hostility against commodity investing, and I've had many discussions about this. I just want to show you two curves which actually start in the year 1900, and it shows you the difference between a spot investment into commodities and a total return index. And because there is an observation that obviously spot commodities over long periods don't move much, it's taken as an indication that commodity investing is not profitable. And that's just not the case, because as you can see, if you look at the total return index, and we use data from AQR here all the way up to 1959, and then in 1960 I switched to the Bloomberg Commodity Index because the data becomes available. And 5.1%, and that's after subtracting inflation. That's a pretty good return. That's actually between what you got on equities and what you got on bonds for the entire period. And so we just want to talk a little bit about why commodity investing, this is futures-based, mind you, is actually so profitable and rewarding. And the counterintuitive thing that we need to talk about now, and this is data from AQR the whole way now, starting in 1877 and going up to 2020. On the left side, I'm comparing the, now it gets, now is where the statistics start. I'm comparing the arithmetic and the geometric average return. And the geometric return is essentially what you got for that particular basket of up to 29 commodities over the whole period. And you can see that the return indeed was 0, which is actually, a lot of academics agree on real spot returns over long periods not being dramatically different from 0. I know that's probably controversial today after everything else that we've just heard and will hear. And that obviously does not take away from any argument about supply and demands and big cycles in between. But let's just let it stand as it is, because this is historical data. And yet, if you look at each single year, you can see that the average commodity has actually risen by 4%. Now, what explains this discrepancy is obviously, if it's very volatile, and if something falls by 50%, it has to rise by 100% to reach 0 again, right? And so that's what explains the difference between arithmetic and geometric returns. The story changes, however, if now you make an equal weighted index of all these commodities, and now, the geometric average all of a sudden is 3.4%. Why is that the case? Because of constant rebalancing, because it's equal weight. So you have to always take out something from the commodities that have risen and put it back into the commodities that have fallen, and establish the same weighting mechanism again. And this is just extremely powerful. It works in all asset classes. Every portfolio management, if you're disciplined and you stick to your rules and you rebalance, you will have an additional return. But it just works particularly well with commodities because they're so volatile. The average commodity has a 30% volatility, and they're completely decorrelated. I mean, if you look at the BCom at the moment, there's 24 commodities in there. It's totally kind of individual stories. In the market for lean hogs has very little to do with the market for cocoa and the market for heating oil. Yeah, it's just different rules. And so that's why rebalancing works extremely well. And that's how basically out of nothing, you've created now a return of 3.4%. And there's actually some studies done in 2006 already by Claude Erb and Campbell Harvey And they dubbed it, I call it, it's turning water into wine. And we're now, as we look at modeling commodities, thinking about how can we actually quantify this. And the interesting thing is we can roughly quantify, we can approximate it. And it's this little formula here. You don't have to memorize that. It's just essentially, you take the weighted sum of the difference between the individual commodities variance and its covariance with the portfolio. And we now use that to build what I call a building block model. And that's not our only model. We always have several different ways to estimate future returns. But what you can see is several components of the total return of the Bloomberg Commodity Index. And this is, as of August 31st, what we estimate the diversification return to be. And obviously depends on the recent structure of the commodity market, of the correlations and the volatilities. And we then add to that an estimate of the spot return. This is where we essentially take a very long-term exponential average of real commodity prices for all the single commodities. And then we just look at how much are they above or below. And because we're a little bit above, then this is a real model, remember, so there's no inflation in here. And we're a little bit above, so we assume over the next 7 years that normalizes, so we get a small negative component. And then you obviously are investing in the futures market, so there is a component from rolling the futures. That at the moment we estimate at roughly 0. That's actually a good estimate because over the last 30 years you usually have lost money on the roll. And then you actually get a pretty big improvement of your returns from just the money market because that's where the collateral sits. Total return investment in commodities always contains money market returns. And that used to be irrelevant when we had zero interest rate policies, but it's very different today. So you actually get to a total return of 7.5% in US dollars. And then the story is a little bit complicated because we're euro-based investors. And so we have to estimate the FX impact, and that subtracts another 1.4%. So we come out at roughly 6% per annum for the index. We think the average manager can do better than that, so I think that's a floor. But I think that's pretty competitive and actually not far from what we estimate the global equity index to provide in terms of euro-based returns over the next 7 years. You may think now those models, yeah, that's all very complicated, but who knows if it works. And I just want to show you, obviously, before we put these into action, we backtest and we run some calculations. And the backtest is actually not carry a lot of risks here because we only use data that we could have had at the particular point in time. You can see, especially on the left side here, the fit is very good of the model. And this is not data mining. This is all based on the way that the asset class actually works, based on the actual return generating mechanism that has been demonstrated and documented in many academic studies. And then if I put it into the regression analyzer, I can actually see that all my 4 parameters are highly, highly statistically significant. We're talking 98% and more. So we can obviously explain a good part of future commodity returns this way. Model gets a little bit less reliable if you add in the foreign exchange impact from the euro. As I said, that's why we invest into commodities. There is and now I'm coming to the point where you will say, it makes sense again. There's another way to invest into commodities, obviously, and that's through resource equities. So if you look at resource equities, you have essentially the same story in that even if the underlying spot commodity returns 0 or close to 0, this is actually pretty good. It's a different time horizon. We're now starting in 1945. But there is a significant equity risk premium. And I can tell you that picture doesn't really change if you go through longer periods. There is a couple very nice studies conducted by GMO, and they start in 1925, and they also get to 8% or so total return with more or less zero spot returns. And so there is a very significant risk premium associated with resource equities. And the story gets better if I tell you that that has actually outperformed the S&P 500, so by 2 to 3% over long periods. And B, it's provided much better inflation protection than the S&P 500. It's had more stable average 10-year real returns than the S&P 500. And altogether, it seems to be the better investment as far as I'm concerned. There is just a question now, obviously, about the risk. And we do invest a little bit into commodity equities within the context of the fund. And then obviously, you know, if I put my fact sheet on a monthly basis, it has to be classified as equity risk because, you know, the regulator wouldn't have it any other way. But is it actually? And so we've run some correlations for you, and it's really interesting. Correlations depend always on the time horizon over which you calculate them. And so if you start and you do that over a 1 month period, then yes, indeed, you can see commodity equities are over 80% correlated with global equities. This dashed line here is resource equities. We're using the S&P Global Natural Resources, and we compared it with the MSCI World. They also have a pretty high correlation with the Bloomberg Commodity Index, by the way. And then what we do is we just go out and we run the same calculation over different horizons. We do 3 months, we do 6 months, 1 year, 3 years, 5 years. And you can see the longer you look out, the less and less correlated it becomes with equities. And after a year, it actually just drops off. And at the same time, the correlation with commodities is rising. So it just goes to show you that what risk you have in your portfolio depends on your time horizon as an investor. And over a longer horizon, actually, resource equities are commodity risk. And that's why they deserve to be a part of our commodity allocation. And that's really what I wanted to tell you. You know, just a brief summary slide. The fact that spot commodities do not offer a meaningful real return is actually not as bad as it sounds, because a zero real return actually means a nominal return equal CPI. So you already get the inflation protection from that part of the spot market. And then, you know, a diversified portfolio of futures contracts, it just gives you the added benefit of diversification returns, which we have been able to quantify. The roll yield, which I wouldn't hang my hat on getting too much money from that. The collateral return, which today is attractive again. And I can tell you that in our sample of managers, the average active manager beats the Bloomberg Commodity Index by 1% per year. So you have that as gravy on top. And then there is the additional opportunity to invest into commodity equities. We're an investor into the LT fund, so I can testify to that. And it carries a significant risk premium. And that's all I wanted to say. If you get the download the presentation later, there's a few additional literature for further reading. And with that, yeah.